In this month's Economic Update, Kaplan Professional Education's Trevor Trahan speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly Economic Update. I'm Trevor Trahan, and this month we're speaking with UBS's senior economist George Tharenou. Thanks for joining us today, George.
Cheers, nice to see you, Trevor.
What are your overall expectations for the Australian economy in 2015?
We think the Australian economy will remain sub-trend, below average in 2015, with real GDP growth of about 2.8% year on year. I think the big forces driving the Australian economy is the ongoing support from record low interest rates, as well as the recent further depreciation of the currency. In the background, these supports are helping to offset the drag from mining capex, which has fallen sharply, as well as the ongoing government fiscal consolidation. For the consumer, I think the other thing is rising household wealth and rising house prices. We'll probably see consumption supported in that households will draw down on their savings rate, because at the moment they've got pretty weak real income, and that's likely to persist for a while. So that lower savings rate will really help support consumption spending. Another support to the consumer is the lower currency, I think, will cause Australians to take less overseas holidays, which had been booming for the last decade, and that will shift spending back towards the domestic economy. Elsewhere, the housing market is going from strength to strength with a record level of activity, with building approvals holding around a record level of 200,000. That's a moderate support to growth. And we're getting the payoff too from the mining capex boom in prior years with very strong export volumes. So overall, these factors should help support a relatively subdued but decent pace of growth in the Australian economy.
What is likely to happen with interest rates in Australia during the coming year?
We expect the RBA to keep the cash rate at a record low level of 2.5% for all of this year, so it'll be the second year in a row. What's happened recently is markets are toying with the prospect of further rate cuts from the RBA, given global factors where there's been a bit weakening in oil prices and commodity prices have been falling. But I think these things tell you a lot about the weakness that's going to happen in the nominal economy. But the real economy is actually going to be supported, I think, by a lower currency, which over time will start to support the domestic economy, and as well as the fact that the labour market is starting to show signs of improvement. We've seen the best pace of jobs growth in a few years, and the unemployment rate is steady. So that's the key indicator to watch. As long as the unemployment rate is steady and the labour market is showing signs of improvement, the RBA will be able to stay on hold for this year. But I think market interest rates, like bond yields, will remain low because of that drag from the big drop in oil prices and commodity prices going on.
How will lower oil prices impact the Australian economy?
Overall, the recent fall in oil prices is a positive for the Australian economy, particularly for households, where we've seen the consequent fall in petrol prices of around 30% since the middle of last year. And that's going to deliver a boost to real purchasing power of households of close to 0.5% to annual income growth in 2015. Now, there is some offset with the fall in oil prices weakening profits of companies in the oil sector, as well as their outlook for investment. But I think in net terms, it is a stimulus to the Australian economy because households will clearly benefit from high frequency purchase of petrol at a lower cost.
What challenges does the Asian economy face in 2015?
Asia is the fast growing region of the world, and to maintain its growth rate since the GFC, it's really leveraged up and increased its debt levels. Now the problem they face is they're really maxed out, where their debt levels now are similar to advanced economies like the US. And so now they face the prospect that not only are they facing very high debt levels, but also because a number of their countries have their exchange rates linked to the US dollar, they're starting to see a tightening of financial conditions and upward pressure on their interest rates if the Fed tightens later this year, as our US economics team thinks they will. So it would provide a significant challenge to the growth outlook for Asia. The other aspect, of course, is since the GFC, global trade has weakened and it's basically been close to flat. And that's important for Asia because the export cycle is the primary driver of their business cycle, because it's an important feed into their profitability and trading cycles of their companies. So I think what we see for Asia ex-Japan this year is a further incremental slowing to about 5.8% year on year, which would actually be the lowest since the financial crisis in Asia in 1998. So it is a soft outlook, but it's not really a sharp downturn because the fall in oil prices is an underlying support.
What are your expectations for China's growth rate over the next 12 months?
We think China will continue to slow down and head down towards around 6.8% year-on-year growth for real GDP in 2015. Now again, that would be the weakest pace of growth since the social unrest in 1990. So it's the lowest pace in a very long time. But China has increased in size a lot over the last decade and had been growing at a 10% pace for a number of years. That was unsustainable because, again, a lot of that growth was being stimulated by credit and leveraging. And the authorities, even though they're likely to cut interest rates over the next coming quarters, given low inflation, they're unlikely to really ease monetary policy in a significant manner. And so they're trying to rein in the pace of credit growth to make it more in line with GDP growth, to stop that leveraging and the financial risks and imbalances building up in China. So the issue for China right now is that ongoing desire to restrict credit has seen weakness in the property market with falling prices and lower construction activity and industrial production. And so that's having some spillovers to the rest of the economy. So it is slowing down, but I don't think it's going to have a hard landing necessarily because the global economy is still doing okay. The risks are to the downside. For instance, if that property downturn became sharper than we expected, there's probably a 15 to 20% chance of China having what would be called a hard landing, with growth going down towards 5%. And that would result in probably having a banking crisis as well. That would be a much more negative scenario for China. But the recent data does look like it's stabilising to something like our view, where it's a moderate slowdown. It's the lowest in a couple of decades, but it's not a crash.
Which nations in Asia do you expect to flourish this year?
I think one of the standout countries in Asia this year is going to be India. India is a bit different in that its cycle over the past couple of years has had high inflation. They've really had difficulty maintaining inflation. So the central bank has developed an inflation targeting framework, much like other central banks like the US and Australia. And they're trying to develop credibility in that target because that's the key driver of getting expectations down. And they've actually been relatively successful in the recent past, helped of course by the big drop in commodity prices, particularly oil. And that fall in oil is reducing their oil import costs. They're a net energy importer. So for India, they're seeing the benefits of falling prices or moderating prices, and that's allowed the central bank to start cutting interest rates last week by 25 basis points, and we think the central bank will cut by 100 basis points this year. And that, with the lower oil prices, will improve households' real purchasing power. And it's also helping to improve the government's budget position and encourage reform in the sectors related to the government. So the overall prospects for India are relatively bright compared to the rest of Asia, which is slowing. So we think India could actually have a bit of a recovery in the next couple of years towards a 6% real growth rate after having slowed down to 4.5% to 5% in the last couple of years, which was the lowest in a decade.
What will be the big issues in the US economy this year?
Clearly the big issue in the US is the Fed. Markets are toying whether or not the Fed will raise interest rates this year. Now, our house view is the Fed will, later this year, start to normalise monetary policy. Last year, they ended their quantitative easing program of asset purchases, and the Fed has been signalling that they want to start to raise interest rates later this year. The reason why that's so important is because many major financial market variables like equity markets and bond markets, both in the US and globally, are really heavily influenced by the Fed. And market expectations have shifted recently that the Fed may not raise as much or raise later than initially expected. And that's really helped crystallise, with the lower oil price, much lower bond yields.
What about the US jobs market? What can we expect on that front?
The US jobs market is clearly showing signs of improvement recently, with employment growth picking up above 2% year on year, which is the fastest pace in 15 years. And it's also driven the unemployment rate down towards 5%. Which we think is the point at which you start to generate wage inflation. And this is the key issue in the US right now, is that you've had much better jobs growth going on for a number of years, and it's recently accelerated, but it hasn't yet translated into major wage inflation and therefore consumer price inflation. And so that's allowed time for the Fed to sit on its hands and not do anything. And markets have been thinking that it just won't come through. But our house view is that you will continue to see ongoing strength in US spending, so GDP holding around that 3% pace. It's actually been a bit better than that in recent quarters, again supported by the lower oil prices and the ongoing momentum in the economy with better jobs leading to better spending and better investment and so on. So I think the jobs market does look positive, and you will get to the point where the unemployment rate is close to 5%, and that starts to approach what economists call the Tharenou, the point at which you start to see inflation accelerate. And again, that's going to be the key trigger to get inflation up towards 2% and see the Fed start to raise interest rates later this year.
Which areas of the US economy are likely to prove most vital to its success this year?
Well, for the US, the key sector is always the consumer because it's the largest, around 70% share of the economy. And the signs there are positive. You've seen rising household wealth in the US, and the pickup in the labour market that I mentioned is really been now recently coupled by lower oil prices, improving real purchasing power of households. And these factors together have seen consumer sentiment, as surveyed measured, lift to the highest in over a decade. So consumers are feeling pretty happy right now, and the fact that their income growth is improving does suggest as well with the confidence that they'll be willing to spend that income. So it does look like the consumer should be able to hold a pretty solid pace and be the key underpinning for the US economy going forward.
Can we expect another tough year for the economy in Europe?
I think Europe this year will remain subdued, but it should be less tough than it has been in the last couple of years. Now the reason for that is the very sharp fiscal tightening and austerity measures that have been in place for the last couple of years are starting to fade because they've had some success in improving the structural budget balances of the government sector, and there's less political pressure to have spending cuts coming through. The other factors are that monetary policy is set to become even more accommodative, and it's already had zero interest rates for a while, but there's going to be an increase in asset purchases which should improve sentiment around the economy. And of course, the recent fall in the euro currency, combined again with a low oil price backdrop, improves real purchasing power of households. So I think these things together mean that you probably will see European real GDP growth pick up towards 1% this year, but they can't really do much better than that unless they have some sort of tough to do structural reforms. And there's a lot of political resistance to that, and so it's unlikely to happen in the near term. So Europe muddles through with a subdued growth rate, but it's just better than what it was, where it looked like it was tipping back into recession last year.
What is the latest on the inflation and potentially deflation situation in Europe?
European inflation has fallen more sharply than expected over a number of months, with headline inflation in Europe overall falling into negative territory recently, and that is the weakest since the GFC. So I think what that's going to do is crystallise the willingness of the European Central Bank to conduct large-scale asset purchases. And we think that'll happen this week with the ECB announcing a €1 trillion asset purchase plan or quantitative easing, including sovereign bond yields. So this shift in expectations is really been quite recent because there's been significant opposition from some members of the European Central Bank. Things like the Germans in particular have been opposed to this idea of QE. But given the extent of weakness in inflation and just how far it is from their target of close to 2%, means that we think that the ECB will overcome the opposition and you'll see a significant easing of monetary policy this week.
Thanks for your time today, George.
Thank you, Trevor.